Welcome to the lecture Mastering Interest Rate Derivatives. I'm Tim Glauner. A quick note about copyright and trademark. The outline of this course is as follows. We'll start with an introduction about value at risk in general, and then we will talk about three different methodologies that are commonly used in practice. One is parametric VaR, the second one is Monte Carlo VaR, and the third one is historical VaR. And then in the last section, we will talk about the pros and cons of each methodology after we have introduced them in the previous sections. So let's do an introduction. What value at risk actually does and measures. So it's a measure to calculate the loss of a portfolio, a probabilistic measure where we define over a certain period in a given confidence interval. We will define what confidence interval is later, what the possible loss on a portfolio is. As mentioned in the introduction, there are three main methodologies. We will go through these methodologies: parametric VaR, historical VaR, and Monte Carlo VaR. And each of the methodologies has been around for many years, and they have their own advantages and disadvantages. So we will go through the methodology and then of each of the methodologies and provides the pros and cons of each. We will really focus, there are many asset classes in the world, but we will focus on fixed income, which are bonds, interest rate swaps, and FX products, with FX products mostly FX spot and FX forwards and FX swaps, but we won't talk much about options. So let's start with parametric VaR. So parametric VaR, also some people call it covariance VaR. So we calculate basically the portfolio's volatility and the mean return. And then based on these two measures, we calculate or we assess what the possible loss is. You will see that, periodically that the confidence level of a loss is based on the volatility or the variance of the portfolio's value. So then the portfolio, how do you calculate the portfolio volatility? It's basically based on the volatility and, very important, the covariances of the sensitivity to the underlying factors of the portfolio. So for example, if the portfolio has sensitivity to the SOFR curve, we can then calculate the sensitivity to certain measures, sensitivities to shifts in the SOFR curve, like for example key rate durations, and then we calculate what the volatility and the covariance of these sensitivities are to get the overall volatility of the portfolio. There are many assumptions, but two major ones is that the portfolio return has a normal distribution. So the mean and the volatility basically define the portfolio returns. And the second assumption is that there's a linear relationship between the asset prices and the factors. And sometimes we take the volatility into account in the first order and second order. Let's just ignore this. So the linear relationship, because the volatility is only based on the sensitivity, which is the first order, that there's a linear relationship of the asset prices and the factors. Lastly, the covariance matrix is very important for assessing the overall portfolio volatility. So we need to make sure we use this approach that the covariance matrix of all these underlying items where we calculate the relationship between them, that we can measure them in a reliable manner. So what do we need to calculate parametric VaR? So first we need historical market data, and that is not really to calculate necessarily something based on historical market data, but it's input because we need the volatilities and the covariances of market data. And the market data then can include prices, can include yields or rates, interest rates of the curve, and FX rates. The quality of this data is very important because, again, we need to calculate what the volatility and the covariances are of the underlying data. So we want clean data, we want to have comprehensive data, and we want to have daily data. And we also need consistent data, and we need to do some normalization because we will compare with covariances things that are not easy to really compare. For example, an interest rate and an FX rate, or a volatility, and the covariance among these variables we need to possibly think about. So the mathematical model is then that the value at risk of the portfolio is based, we mentioned that before, that we have an expected portfolio return. Then we have a standard deviation, we call this also the volatility of the portfolio return. And then we have something called the Z-score. And the Z-score allows us to, if you have a normal distribution, to define a certain confidence level, and then we take a certain measure of the volatility. So for example, the Z-score with, if you want to have a 95% confidence level, you would take Z as 1.96, and there are tables you can look up for 99% confidence level or 99.99 confidence level, or probably you don't go lower than 95%. So the VaR formula is then this expected return, if we go back to the formula, minus Z to the standard deviation of the portfolio returns. Now remember, this is the standard deviation of the portfolio return. So later we will show how you do sigma p, because then sigma p basically comes from all the underlying factors and the covariances. So I mentioned that on the bottom. So calculate sigma p uses the covariance matrix of the sensitivities of the underlying factors. So this value at risk formula is very simple, but basically the mean return is also not that hard, but the sigma p is the more involved one. So how do we calculate it? So for example, for fixed income, so for a bond, we look at the change in interest rates. Now, you could argue that you want to have credit assumptions in there as well. So you can certainly add this, but in our case, let's just look at interest rate changes. So for example, for a bond, we could look at the duration. So that measures the bond sensitivity to change in the yield. And we can use convexity. So we have a little bit of the second order approach, and it adjusts for changes in duration as the yields change. So we mentioned before, it's a linear relationship. So here it's not completely linear, but again, it's only, first order and second order. So if you have really complex functions, it might not cover that. There are always special examples that you can give. So then how do you calculate the value at risk of an individual bond? So that is the formula. So it's the principal times the price times the duration times the change in the yield. So duration times change in the yield, you will see that many times. And then plus, and then now you have this convexity term. So it's 1/2 times the convexity by the change in yield squared. So that is a standard formula. You will see that many times, how you can basically approximate a change in value by this duration times the change in yield plus 1/2 convexity times change in yield squared. Now the sensitivity here, we only have one duration number, but we could also, for example, take the sensitivities of key measures in the interest rate curve to have more precision. So for interest rate swaps, the duration measure is very uncommon. So, and you don't have a historical price. So usually we calculate VaR based on the sensitivity of market data inputs. And here we can, we could do a DV01, but we also have sensitivities to spreads, volatilities, or any other market data input. So we'll go here into more detail. So to determine the DV01, we basically here we want to take each point in the yield curve. We can do the same thing for bonds as well. So now we have the DV01 and it represents the sensitivity of the ith yield curve point. So here, for example, we see on the left side the SOFR curve with the money market rate of a bunch of futures and then swap rates. So one approach is we shift each point in this curve, each market data point, by 1 basis point, and we calculate what the change in mark to market is. We can also convert the whole curve into just swap points kind of synthetically. And then we shift the swap rates, like for example the 1 year point, and we could add here 6-month swap and 1 year swap, and then just shift swap points, but different people do it differently. And then if you shift the swap rate, it's called a key rate duration. So these are, for example, sensitivities. So then step 2, and usually this is actually done before step 1, we gather historical rate changes of each relevant point in the yield curve. And we have sigma yield represents the change in the rate at the ith point on the curve in time. Let's call this rate changes instead of yield changes. We calculate the covariance. Just write this down. Then we calculate the covariance between the rate changes at points I and j. The sigma ij, we can look at the formula. That's the standard covariance formula. And where we basically have the change is where we basically take over n observations, we do that. So then we calculate the portfolio variance. So here we have all these different DV01 on the different curve points, and we have the covariance, and that gives us the overall sensitivity. Now, standard deviation is the square root of this variance, and then the parametric VaR is given by z square, and we ignored here the mean, so we just say the mean is 0, and the z-score is basically given by the specific confidence level. Now the thing for FX rates, let me just throw it out. So FX rates impact portfolio has on the currency exposure, and we calculate VaR, the volatility based on the FX rates, and then the correlations between the currency pairs with the covariances. An example for a single currency pair is, the position times the vol times the z squared. So let's stop here for now at slide 19. Now let's talk about software implementation. So a few broad strokes. What we've seen in terms of the whole development stack is R. It's a programming language. is very commonly used for statistical analysis, as well as Python. So R is probably more rigorous than Python if you're a hardcore quant. However, Python has, in addition, a lot of features that R doesn't have, but both of them can be used. So Python also has a very large set of libraries. Python is good for AI development nowadays. And then as a front end, Jupyter is basically an interpreter way of Python, where you can do interactively write almost like documents that have Python code embedded. And large language models nowadays should be used for code generation. In general, I think you should use large language models as much as possible in your daily life. Then a few comments about best coding practices. I think it's general, but some important points to point out. Modular design. Try to write good code. Do extensive testing, do unit testing early on. And very important is to use version control for reliability and reproducibility. Version control is especially important if you work with multiple people. It's still amazingly that it's often not used that much. So source control, version control is critical. If you have production code, it requires some discipline. At the beginning, it's probably good to have an administrator who does all the source code versioning and the releases. For value at risk, in particular, you need to do validation. So you need to compare historical data to your P&L. You need to do stress testing to ensure that your models are stable in the production system. And then you want to have the ability to drill down from your portfolio into the individual trades, but also into the individual risk factors. So the risk factors are important because you could have certain assumptions, not in parametric VaR, but in other VaR methodologies, where certain paths have very unreasonable market data assumptions when we shift the curves. You will see this later. So let's move on to Monte Carlo VaR. So we'll talk in this section explicitly just about Monte Carlo VaR. And here we basically have a mathematical model that simulates the underlying risk factors. And from these simulations, we derive basically a distribution of the portfolio prices by utilizing pricing models for the trades. Again, we'll focus on bonds, interest rate swaps, and FX products. And we discuss also the process, how we want to model or how we should model the risk factors to calculate value at risk. So first, let's talk about modeling of the actual asset classes. So for a bond, we need to model the bond prices, and we need pricing models. So pricing models are based on interest rates, volatilities. There are many other factors. It really depends on how you model, for example, credit assumptions or inflation assumptions. And then there's the concept of OIS, option adjusted spread. This is the spread on the zero curve to make your model match the actual liquid market price. For interest rate swaps, you want to look at the pricing changes via pricing models. There are also callable structures, and if you have callable structures in a Monte Carlo simulation, you really want to try and do full valuations. So for Bermudan callables, that's a challenge because you have simulations on pricing models that often have stochastic simulations as well. But that's the ultimate goal, to have full valuations on the simulations. For FX products, you need to model the FX rates. And if you have options, the volatilities and pricing model inputs, and you calculate basically the fair values based on these model inputs. Keep in mind, projected forward rates need to conform to interest rate parity. So that's all embedded in your model. And to be consistent and arbitrage free, you need to simulate the underlying basically risk factors, or interest rates and volatilities and foreign exchange, to be arbitrage free. They need to be observable, so you need to reproduce market observed prices, and you want to have consistency across all the market data and all the pricing models. Then you need to generate simulations. So for interest rate models, you have models like Hull and White or BGM. They generate future interest rate paths, not only of the spot rate, but of the whole curve. Then you have foreign exchange. So, for example, you can employ a Brownian motion, or you have a stochastic volatility model like Heston. There are different FX rates. Now you need to basically model interest rates and FX rates at the same time. And that implies that you need to model the correlation between interest rates and FX rates. And if you, for example, have equities, then you would need to incorporate equities into these models. There's a concept of two different types of volatilities. The one is called risk neutral, and the other one is real world. So real world means that you basically utilize historical market data, historical relationships of the underlying variables. However, the real world variables is often used for risk management. If you want to hedge it or price it, you really need risk neutral volatility. So the risk neutral ones have risk embedded, and you need to calibrate your volatilities to market instruments. So the easiest way to look at it is real world, our volatilities and correlations, but mostly volatilities based on real world volatilities of observed market variables, and risk neutral need to use instruments that are traded in the market, and then you calibrate your volatilities to reprice these risk neutral these instruments to get risk neutral volatilities. Here you can already see this requires, I talk about it lightly, but it requires rigorous math and a significant amount of expertise to also then explain the results and the simulations to end users or to executives. So then you generate random scenarios for each risk factor in a correlated manner, and you have basically these risk factor models. And I mentioned it before, for interest rates, you need to model the entire yield curve, so that you have basically for each simulation at the time horizon, you have basically the yield curve modeled. And therefore you need to reflect the time horizon for your VaR calculation and the appropriate granularity of your time steps in the VaR calculation. And the time steps are important also because you age your portfolio. If you have a VaR calculation, time period is 1 year forward in time. You need to age and simulate your portfolio forward to 1 year. Now then you calculate the value of each trade under the position under the simulated market scenario. So you have your market scenarios, and then in practice for valuations you sometimes use shortcuts. For example, a Bermudan swaption might be replicated with a European swaption, and that's not best practice, but I've seen it in the market. But the ultimate objective is to do a full valuation if you can. So then the step basically where you put the portfolio valuation, either you have a distribution because you have all these Monte Carlo simulation paths. You have a distribution of portfolio values at the end of the simulation period. And then when you have this distribution, now you can sort the values of your underlying trades or of your portfolio. And you can, for example, now calculate 95th percentile confidence level, which would be a 5% chance that the losses will exceed this amount. And the 95 confidence level, you would apply a z-score based on the formulas that we previously had. So the ultimate goal is to calculate at what confidence level will I incur these types of losses. Now, Monte Carlo VaR, it's a comprehensive risk assessment. It incorporates all the non-linearities because we have this Monte Carlo simulation of the underlying risk factors. So it's very good for complex instruments, but it's very computationally intensive, especially if you have complex deals. But it is a very important tool for sophisticated financial risk management. You don't necessarily need it for regulatory purposes, but a risk manager should have it. And VaR is commonly used for regulatory purposes, but in my view, it's even more important for internal risk management, and therefore Monte Carlo simulation is a very important tool. So now from here, let's move on from Monte Carlo VaR to historical VaR, which is actually very commonly used for regulatory purposes because it's easy to understand. So let's look at it. So here in this section, we'll look at only at historical VaR methodologies. So there we use actual historical factors such as market data or volatilities to estimate these potential future losses at a certain confidence interval. We'll again look at fixed income, interest rate swaps, and FX trading portfolios. So what we need from a data perspective, again, we need historical market prices like before, but the purpose this time is different. Before, we needed historical market data to calculate correlation and covariances. Here, we actually need the historical market data to actually generate the actual scenarios that give us the distribution of the market data of the prices of the portfolio. We need a significant amount of time horizon going backwards so that we have enough samples to have a meaningful distribution. And here it's even more important than before. The data integrity is very important. And it's also important that it's clean, that it's complete, that we don't have gaps. And individual outliers can have a huge impact because it basically has a direct impact on the portfolio value in one of the scenarios. So the methodology is, how it works is, First, you look at all the different risk factors. Like imagine they're just curves. So you collect this time series of risk factors. Let's say there's a SOFA curve, and you take the last 5 years of let's say 1 year. You take the last 1 year of SOFA curves, and then based on these SOFA curves, you generate 0.2. You generate a set of factor changes. So you calculate every day how much does my curve or my risk factor change, and you note this and you save it in some array that you have for all the different factor changes. You have now a time series of the changes in the rate. So for example, for the SOFA curve, you can look at the changes in the zero rate from day to the next for the last 250 days. So yeah, now you have these zero curve changes. I'll just call them shift curves. Imagine you have all these shift curves now. Then you generate the risk factor scenarios based on today's risk factors, so today's zero curve, and you apply these shift curves. So you apply these historical changes of risk factors. So as an example, based on today's SOFA curve, the zero curve, you create 250 scenarios by applying the zero curve changes, we calculate in 0.2, to today's curve. So now I have basically 250 scenarios. And at this point, the algorithm is the same process as the Monte Carlo simulation, because I have all these different scenarios. And if I have more risk factors like curves and foreign exchange and volatilities, I have all these different scenarios, and they're you can imagine, very complex scenarios. So there's no actual mathematical model. It's really an explicit change in the market data. So then you calculate, now I have these 250 scenarios. 0.5 is that I calculate the value for each trade under the simulated market data scenario. Then I sort the returns again from worst to best, and I determine the value at risk at the specific confidence interval, the confidence interval. So for example, if the 95th percentile is -2%, then there's a 5% chance that losses will exceed 2% of the current portfolio value. So for historical VaR, back testing, also for the other models, back testing should be applied. So back testing means that I look at my actual P&L, my clean P&L actually, and I see if my historical VaR is really consistent with my actual observed back testing results. Then there's stress testing. So you can simulate extreme market conditions, and you see if your VaR changes very significantly or if it behaves in a robust way. And you probably have to continuously adapt new market data sources. For example, SOFA just got introduced and LIBOR went away, and you need to look at model assumptions if basically things happen in the market. So historical VaR is important in risk management. It emphasizes and it's crucial to have good historical data and to do model validation and enhancements. You can think of maybe you want to integrate more granular data, and you need to adapt to new market conditions and regulatory requirements. Let's look at each of the methodologies, at the pros and cons. So first we'll look at parametric, pros and cons, then Monte Carlo, pro and cons, and historical pro and cons. And the pros and cons are relative to the other methodologies. So let's run through it. So parametric VaR, it's very efficient. So you just need to calculate the sensitivities, and you have the vols and the correlations pre-computed. So it's very efficient to calculate. If it's very efficient, it's also fast. and it scales. So because the sensitivities, you sometimes have them already in other risk measures, so it scales very nicely to large portfolios. It's the confidence level, the mean, the volatility correlations. It's a known mathematical thing, and it's commonly used in other applications as well. So it is used by regulators in the industry. So there is the SIM methodology, that's the standardized approach for initial margin calculations, and for the fundamental review of the trading book SA. These are very similar concepts where you calculate the sensitivities, and then you have some mechanism to basically take the correlations and the volatilities into account. Now, cons, it's kind of serious cons, especially in internal risk management. This normality assumption is not really a good assumption, that you can just, based on your volatility, your mean and volatility, calculate VaR. So you're vulnerable to inaccuracies in the model. Also, traders can arbitrage it. They know how the model works. It's very bad at tail risk because it just has this normal assumption and this linear assumption with first and second order relationships, and it just really oversimplifies complex portfolios. Having said that, it's still used commonly in all kinds of forms. Now, Monte Carlo simulation, the pros, you can have as complex of financial instruments and as possible. Just write this down. In financial instruments and market data, the scenario is simulated, so you can put as much sophistication into your scenario analysis as you like, based on economic and other scenarios. It is very good in risk estimation for portfolios with derivatives because it has this precision, and it does well with tail risk. You need enough paths and distributions, but there's no reason why tail risk cannot be taken into account because it is a Monte Carlo simulation. And diversification is taken into account inside of the Monte Carlo simulations. So because it requires these dynamics with many risk factors, it requires a significant amount of model sophistication. So the people who build the models, but also who explain the models, need to be in the bank or in your financial institution. Because you have this, again, depth of sophistication, there are a lot of assumptions and models, so you need to be comfortable with them. It's computationally very intensive. If you have callable structures or complicated FX options where you need a stochastic model to actually value the deal, and then you have the stochastic Monte Carlo simulation on top of these stochastic pricing models, so it becomes very heavy. Data requirements, you need extensive and high quality data, and the complexity, if you get results, it is often difficult to implement and to understand what the end results are. And you have randomness, so therefore, because you have stochastic nature, you need good seeds, probably random number seeds, but you also, again, it goes back to this explaining the results. It's not easy with a large Monte Carlo simulation. Now, the historical VaR has some very appealing features, but also issues. First of all, it's simple to understand and implement because you have all these different risk factors, and you can look at the individual risk factors, how they have changed. There's very little assumptions because it's an actual distribution historically. it reflects actual historical market data, but also, it only looks at the history for a certain period. It's very easy to explain. You can justify it because it's a well-defined methodology, and back testing is also more straightforward than the other ones because you will see that your P&L is related to the actual scenarios. It's similar to some hedge accounting methodologies, which is just an interesting way of looking at it, that accounting kind of goes hand in hand with risk management. So it's hedge accounting specifically. So the negatives is, in a certain period, it basically assumes that the future is similar to the past. So you remember when interest rates were almost zero for many years. So when you ran historical VaR, it basically took all these zero rate changes into account, and this is not really applicable nowadays. Often you have limited data, so you do need, for historical market data, you need all this data that goes into the pricing models as a time series, and it's non-stationary. So the economic relationship may change over time. I just mentioned before the 0% regime of the economy is very different from when it's 5%, or rates at some point were 15% during the oil crisis. So things do change, and so therefore you need to be careful with historical VaR, and you need to take these changes into account, or at least be aware of it. There's no tail risk, except if the tail risk is really in the historical time series, but often it's not, and it's not really flexible in terms of running a method where you maybe want to shift all the market data. So you run scenarios on your VaR calculation because you have this kind of historical data rigor, and sometimes risk factors change. So here you need basically this time series, but imagine a trade has changed to SOFR, and then 5 years ago you have only LIBOR rates. So how do you value this SOFR trade today based on LIBOR rates if it didn't even exist? So in terms of entire summary, and this is mostly my personal view, Monte Carlo is very flexible, it's very accurate, but it's complex and computationally intensive. Historical VaR does have complex scenarios based on the history periods. It's simple and transparent, but it assumes that the future mirrors the past. Parametric VaR is efficient and quick. It has very clear assumptions, linear approximations. So it's good if the assumptions are clear, but sometimes the portfolio is too complex, and it's not adequate nowadays. Sometimes. Parametric VaR is also computationally efficient, but it basically relies on this distribution assumption. And the covariance estimates also need to be well done. So the VaR methodology it depends on the portfolio. It depends on how much data you have, your specific needs, the sophistication of the quants, the sophistication of the vendor, how well you can interpret basically the results. There are some specialized risk SaaS solutions. So SaaS with the cloud scalability has gone up, computing power has become cheaper. So some of the complexities of Monte Carlo simulations and the computational intensity is not such an issue. And in my view, historical and Monte Carlo VaR, if you do good back testing, is the actual, so backtesting to the actual P&L is, in my view, the recommended way. So this was basically fairly detailed, I think. We gave an introduction of VaR in what VaR actually is and why it's used. Then we looked at the three methodologies: parametric VaR, Monte Carlo VaR, and historical VaR. And then we looked at the pros and cons of each methodology. Please reach out if you have any questions, so do not hesitate at any point in time, or if you have any recommendations in terms of adding things or removing things. We're very open to providing updates to the course. Thank you very much.